Good morning, John. How are you today?
I'm doing awesome, and it's great to be with you, Peter.
Well, it's great to have you on. I appreciate you coming on. Somebody forwarded an article of yours to me, "Ubiquity, Complexity, and Sand Piles," which I ended up
Right.
reading. I ended up reading it twice and thinking, I need to talk to this guy. And actually, what a day to talk to you. I'm talking to you on the day that the first country in the world has made Bitcoin legal tender, and I'm in that country. So it just feels nice to actually talk to somebody who isn't totally in the Bitcoin rabbit hole. So welcome to my show, and going to be good to talk to you. So what we should do is start off. If usually have lots of Bitcoin people on the show, and everyone knows who they are. Some people might not know who you are. So can you just give a bit of an introduction to who you are and your background, so we can
Well,
sync people?
I'm an investment advisor, money manager, but what I'm known for is I write a newsletter that goes to a million or so people a week. It's free, so the price is right. And I write about whatever interests me that week. Last week and this week, we're talking about labor shortages and how that's playing out into the economy and why it's actually has the potential to slow the economy down much faster than economists were projecting, 3 or 4 months ago. Well, that's a problem if you get down to what I call stall speed, which is 1% GDP or less. Then anything that happens pushes you over into recession. The Federal Reserve has already got its foot on the gas pedal. They've got nothing more they can do. I think they've already made the policy mistake. They should have, and we can talk about this if you want to, but
Yeah,
they
I'd
should
love
they
to.
should have been reducing the amount of money they're spending and raising rates starting earlier this year when the economy was recovering. It hadn't recovered completely, and they seem to want the pursuit of perfection to be there before they start backing off. And what that's going to mean is, given all of the problems that we've got now, I think perfection is going to be a very difficult thing to obtain in the short term. The short term being, 1 or 2 years, which means they're going to continue to, with the QE, continue with the low rates, and that has the potential, and we can get into this, to give us inflation. We're already seeing inflation, but the one thing the Fed has been good at since Paul Volcker was controlling inflation, and they're not doing so good now. So, and they're getting ready to repeat, I think, some mistakes by a former Fed chair. So there's tons of areas that we can go to.
There's so
I've got
much.
I've got 5 bestsellers, 7 books, and lots of TV and all of the normal stuff that people get with media. But as we talked earlier, I'm often wrong, seldom in doubt, but I do have opinions. So just you ask, and I'm here.
Well, there's a lot to unpack there, and I feel privileged to have you on the show because after the article I read that was sent by a friend of mine, I have been kind of diving into some of your work, and I've really enjoyed your work because as someone who likes things explained easily, your articles, which I will share in the show notes, and I'll get people to subscribe. You break things down in easy way understand, easy ways to understand, especially the metaphors you use.
Well, it has been my gift, as I'm not really an economist or a writer as much as I'm a storyteller. And
Definitely.
so I tell the story about investments. I tell the story about economics. And we're much more comfortable as human beings with stories when you can bring something into that's complex and make it relatable into a story. We tend to understand it easier, and that's just been my gift. My friends that know that I have an Irish heritage, they say I kissed the Blarney Stone.
Oh,
So
well, I know the Blarney Stone. I'm half Irish. My father lives in Ireland, so
yeah.
I've been to Ireland nearly 100 times. So I like a bit of Irish heritage. Okay, well, let's start with labour shortages because this is something we are seeing in the UK. I'm not in the UK right now, but there's a number of different sectors that are seeing labour shortages. I know specifically in the HGV truck drivers, for example. They're seeing a massive shortage, but we keep seeing news stories of labor shortages, yet we still see figures of high unemployment. So can you explain to me what's going on there?
Well, the answer is there's no simple answer. There's lots of things. COVID is a big part of that. People are not wanting to go out and get into the market. They're concerned about getting COVID with some justification. I mean, there's a significant portion of your fellow UK and certainly for my US citizens they've chosen not to get a vaccine. I would suggest you get one, especially if if you're like me. I'll be 72 here in another few weeks, and you have problems if you come down with COVID. I just don't see the risk of it, but a lot of people do. So they're more cautious about getting back into the workforce. One of the things that's happened in the US, I haven't seen any data from the UK, but we've doubled the number of people doing homeschooling from 2.5 million to 5 million in just the last year. That means, let's say that even 60% of those people had been in the workforce. Well, that's 1.5 million people that are now not in the workforce, mostly women. But that's 1% of the US labor force. And there's an equation it's like 2 + 2 = 4. It's an identity equation. Everybody agrees that it's GDP, that's the productivity of your economy, is equal to the number of workers times productivity. It's very simple. So if you reduce the number of workers, you're going to have a challenge with your GDP. Well, you pull 1% of your workers out now are staying home and homeschooling. We're losing another 1.5 million to what's known as long COVID. Do I need to explain that?
Nope.
I'll just,
No, we know what long COVID is.
If you know what long COVID is, fine. I mean, but that's 1.5 million workers. That's another 1% of GDP. Now, will they get over it? Will they find the cures for it? I mean, it's such a random, very varied problem that we can't put our finger on it, but it's still reducing the workforce. There's skill mismatch. There's 10 million jobs out there that people are advertising, saying, please come to work for us. And, I was driving through rural Maine here a month ago, and I did something that I don't normally do. I pulled into a McDonald's and got a McDonald's milkshake. probably hadn't done that for 10 or 15 years. And I have a theory that calories don't count if they're in Maine. I go to an economic fishing camp there every year. And so a bunch of economists and hedge fund managers get together and we fish and drink. And we use that as an excuse. So you go past the window to get your milkshake and it says $15 an hour, $13.50 part-time. That's in rural Maine. I mean, it's not the city, it's not whatever. And you're seeing that signs all over and people, that's inflation. It's a wage spiral. I mean, there's no other way we can put around it. And you're not going to be able to, say, well, things have gotten back to normal. Now we're only going to pay you $12 an hour. That's just not going to work. So, but there's still not enough people. Some of it is clearly they're getting income from government sources, but that's going away. We're not seeing, from the states that have already done that, we're not seeing a big boost in their employment. So there's something happening in the underlying zeitgeist. 25 years older and younger are not coming back into the workforce for whatever reason. And that's millions of people. And those are the people that work in the hospitality, the hotels, the restaurants, the bars, and so forth. And we saw this last Friday when we had the unemployment report. 233,000. I mean, it stunk up the room. And there were zero jobs in the hospitality world. And some people says, well, that means they're not hiring. And I'm not certain that's the case. It could be they're not working. They just you haven't put the bid in front of me that says I'm willing to come hit your bid to take that job. And frankly, you've got customers that are upset. You're dealing with people that are not very nice to you in conditions where you're working your tail off. It's not exactly. I mean, I worked as a worked in restaurants, when I was in college, and it's not a glamour job. Mm-hmm. So there's lots of things pushing back that's reducing the amount of labor, and that's going to end up affecting GDP. Now, when you get to growth rates, we've run the debt up, and there are so many macroeconomic studies that show that debt, after it gets to a certain portion, and we're way past that in the U.S., you're pushing again in the UK, becomes a drag on growth. I mean, the government starts crowding out private investment, and it crowds out capital expenses. Well, what you end up with is something like Japan, where they've had zero growth now, in nominal growth, zero, for 22 years. Mm-hmm. Now, if you go to Japan, which I have, it's a wonderful place. Yep. Everybody's happy. There's wonderful food. Everybody's working. The trains run on time. There's great cars made, all of that stuff, but they're not, in terms of growing per capita, they're not doing that. And we look at Europe. Europe doesn't have much growth, and yet they've gotten way more debt percentage-wise than the U.S., but the U.S. is doing our best to catch up. We're really working at it. We seem to want to be Italy and Greece.
Well, it sounds to me. So one of the things that sounds to me like there is demand in the economy, but there isn't enough supply of people to support that demand, and that is what is reducing the GDP, because you're not seeing the productivity. I hadn't associated the two. And one of the things that somebody sent me early on, because like I said, I'm not an economist. My background's advertising. This podcast was a complete fluke. I started it as a hobby, and it's now become my job. So I had to study a little bit of economics.
By the way, I relate to that. My letter, I stuck on the internet as an afterthought.
Oh, right. Okay.
I had a print letter just like every other respectable person, and you would sell your print letter, and I stuck it on the internet as an afterthought, and it just blew up.
Yeah.
And all of a sudden, it goes from 2,000 to 3,000 to 6,000 to 12 to 15 to 100. And you go, wow. And then I shut the print letter down because the electronic free model was so much better. So, and which is, you've had something happen. You came on at the right time. You struck gold. And the entrepreneur in you said, this is where I want to go. And it is a lot of fun.
A lot of fun. Well, I struck digital gold, as some of the listeners will say. But something somebody said to me early on was, watch this video by Ray Dalio, how the is it how the economic machine works?
Right.
Yeah. And it explained to me in terms of how cycles work. And when you talk about the build-up of debt, one of the things I keep saying is, why is the Fed in the US and why is the Bank of England in the UK, why are they not allowing the machine to work anymore? Why do they keep kicking the can down the road? And that makes me think of your article. It makes me think of credit cycles, that we no longer have business cycles, and you talked about credit cycles. And so why do you think they're not allowing the economic machine to work how it traditionally worked?
They have theories they work around. It's basically Keynesian, and they believe that keeping rates low and making monetary policy easy, pushing money into the system, is going to increase unemployment, and it's going to increase growth. And the Treasury, under the last year of Trump, especially, and then the first year of Biden, have been particularly willing to go along with this and say, well, let's throw $6 million at it. I'm sorry, $6 trillion at it. And the Federal Reserve has bought almost 2/3 of that. Same thing happening in all over Europe. They think that it's going to make things better. And in the short term, it does. I mean, was the government correct in pushing stimulus when the economy fell out of bed, last February, March? And the answer is absolutely yes.
Yeah.
The car was in the ditch. You got to pull it out. Now, as we start recovering, especially after we get vaccines, we needed to stop. I would have felt, my advice would have been to pull back. You've seen some Federal Reserve regional presidents saying, we've got to start thinking about what they call tapering, which is pushing less money into the system. But they really believe that they can influence unemployment with low rates and easy money. And they've got all of these models that tell them they can do it. And that's what they're working on. And you can sit and talk to your blue in the face why you don't think that works. Doesn't make any difference. They're the Fed and you're not.
So with the Keynesian a common enemy with the Bitcoiners, because the Bitcoiners aren't fans of the Keynesians. And as I understand from your writings, that you don't mind the Fed stepping in, but it should only be at times of crisis.
The Federal Reserve is there for when the ox is in the ditch. I mean, cars, when the wheels have come off. They're the lender of last resort. And as one of your famous central bankers from the 18th century said, from England, Bagehot's rules is the central bank should be the lender of last resort at a high price against strong collateral. So they can push money into the system, but it's money that's not cheap money. So they're the lender of last resort, and that's not what's evolved. Keynes came along and basically said, when there's a recession, you should push money into the system. You should have stimulus from the federal government, and then that's eventually evolved into the central banks as well. And then you pay it back when the times are good. And as U.S., we just never been very good at paying it back. So we had one brief period when Clinton and Gingrich passed some laws that allowed us to start paying down the debt and reducing the deficit. But that was a very, very brief period. And as soon as the Bush came in and the Republicans had control, they went right back to spending money as fast as they could, and it's never slowed down since.
Yeah, that's super interesting. I did actually study economics at school for a short period of time, and one of the things we were taught about was running surpluses and deficits. We don't seem to run a surplus anymore. We constantly run a deficit. And one of the things I was thinking about was why this happens is it's the political cycle gets in the way of the economic cycle, because there's no incentive for any political leader to deal with times of crisis in a different way. Okay, deal with times of crisis by injecting capital into the system, but in normal times, it feels like everyone wants to kick the can down the road and get them through the next election and pass it on.
It's gotten beyond that now. In the U.S., we have Social Security, which is losing. I mean, we're now spending more on Social Security than we're taking in. Certainly with healthcare and Medicare, with all the other multiple benefits, many of which started out as temporary programs. And as Milton Friedman said, the most permanent thing in the world is a temporary government program. So we keep spending, and now we're spending $2.5 to $3 trillion of what's called entitlement spending, and there is zero impetus on either side by anybody to go in and say, well, we're going to cut, your Social Security, we're going to cut your health care, we're going to cut this tax credit, we're going to take this from, there's just no, and what Biden this time with, trying to get his $3.5 trillion program through, he's trying to, it's really more like a $6 trillion program, because they're creating these temporary government programs that only last for 5 years. And they're saying, well, we're only spending, $0.5 trillion on this, when if you counted it for 10 years, it'd be a full trillion. And it's like, there's not going to be any willingness to take away that government subsidy in 5 years. People are going to become to expect it. We're now at the place where 55-60% of Americans don't pay taxes of any other than Social Security, but certainly not income taxes. It's a smaller and smaller group, and they keep wanting to raise taxes on the rich. But you could take 100% of what they've got, and we wouldn't come close to balancing the budget. I think, and I was having this discussion on another podcast with some very smart people that I was in the room for comic relief, but
Come on.
but they were asking me, John, how does this turn out? How do we fix this? And I'm going, well, we don't fix it. We're going to have a crisis. It's going to have to be a major crisis where things just fall apart. And then when things are falling apart, then you sit and figure out what you're going to do. And that's when you have to ask the fundamental questions that nobody in government wants to ask now, which is, how big should government be? Really, how big do we want the government to be? And then ask the question, how do we want to pay for it? Just basics. And right now, everybody wants the government to be really big, and we don't want to pay for it. And that's not going to get resolved until we have a crisis. And maybe we don't. Maybe we become Japan, and because the Bank of Japan has borrowed the equivalent of about $40 trillion. It was in U.S. Well, we're on our way. They're up to 8 trillion. That we owe 28 trillion, 29 trillion now, I think. Plus state and local, it'd be closer to 31, 32. Till we have a crisis, we're not going to solve it. I have things that I would like to do to restructure the tax program, but nobody's going to pay any attention to it. I've talked with congressmen. They say, well, yeah, you could, but we can't get that through. Talking about using a VAT rather than income taxes and consumption taxes and so forth. It's what I call the Great Reset in my writings.
Yeah, you wrote about this way before.
Oh, I've been writing about it for a while.
Yeah.
Because but you can see it building. And by the way, I just want everybody to understand that I'm the biggest optimist in the room.
Great.
I am really long humanity. I think, Peter, you're going to live to be 150 years old.
I don't know. I've lived a troubled past.
Well, yeah, but we're going to turn you back younger. So when you're 150, you're going to be in a 25-year-old body with your mind still running sharp. And if you keep your assets, then there you go. I'm telling you, that is this decade reality. I was just in Palm Beach looking at some brand new drugs that will be on the market in the next 2, 3, 4 years. That it's already in 7 different trials. But the research that I was looking at was showing the fantastic results it's having on aging in mice. And we know it's doing the same thing in humans, anecdotally, but it's working, they're using it for MS and thyroid and a bunch of other stuff. So what's going to happen is eventually, it's already in phase 2. They've already gone past the safety trials. It's going to get approved for some disease, something. It may get approved for PTSD. I mean, all sorts of stuff. And you're going to get it. You're going to go to your doctor and say, Doc, I got this, because you want that drug. It's not the fountain of youth. It's not going to turn you young. It's not going to reverse your age, but it'll help maintain you where you are. Okay?
I'll take that.
Yeah, we'll all take that. There's a half a dozen different programs. I mean, major companies. Amazon just announced it. Google's doing it. Sinclair, Diamond. Everybody's doing. They're focusing in on one particular pathway now, called induced tissue regeneration to reverse aging. I think that happens this decade. Now, how that gets distributed will be a story. But all the other technological progress we're making. So even though we're going to have this, I think, period of tumult economically, government-wise, there's going to be places you can invest. There's going to be ways that you can position your portfolio to get yourself to the other side. I mean, you want to make sure you get from here over to the other side with as much of your assets as you can intact. And then, rifle shot some of these new technologies that are, I mean, we're going to completely change how we do seeds in the world. That is happening right as we speak right now. Europe has just approved a new non-GMO alternative to a GMO that herbicide resistant. It's going to reduce the amount of chemicals we put into the land, reduce the amount of labor and water, everything else that's needed. That technology exists right now. It's going into the fields. It's going to be as big as the Green Revolution was. There's so many wonderful things happening. So, I say this all the time. I'm long humanity. I'm short government.
Well, let's get into that. Let's unpack some of that. My friend Lynn Alden, who I speak to regularly, she's a great economic thinker, great macroeconomic thinker. She talks about this, and she believes we're going to have a currency devaluation. This is how we're going to pay for it. So bondholders will be paid back the nominal amount, but the purchasing power of what they'll be paid back will be lost. Her belief is that's how we're going to pay for this. And through inflation. What are your thoughts on that?
I have a very decisive maybe.
Okay.
That's precisely what I thought was going to happen when I wrote a book, The Endgame, when I was talking about the Japanese, Bank of Japan was going to buy all the government debt. It was clear they were going to have to do that. There was no other way for Japan to survive. The bond market couldn't do it. And I said, in every other case, all throughout history, without exception, currencies always went down.
That's what Lynn said to me. Sorry to interrupt. Lynn said to me, Japan is the outlier. Or 52 of the last 53 countries where they've hit 130% debt to GDP have essentially defaulted. Japan is the outlier.
Japan, yeah, and my line that I used in the book was Japan is bug in search of a windshield, and I predicted the yen to go to 200. I actually thought it would go worse than that. I put on a 10-year option short. Personally, I was going to pay for my house with that 10-year option, and I got the outlier. The dollar is the world's reserve currency. Does everybody in the world say, I want to be in the reserve currency so the dollar doesn't go down relative to the euro or the pound? The answer is I don't know, and nobody else does either. It's speculation. This is one of those things you're just going to have to go through, and you know, people ask me what I think about gold, and I say, well, gold to me is not an investment. Gold to me is central bank insurance. Okay. I mean, I've got homeowners insurance, I've got life insurance, I have central bank insurance, and I buy gold and it's sitting in a vault. And I hope that the value of my gold goes to zero. I really do. Because if my gold goes to zero, that means everything else worked. The world's in a wonderful place. I'm afraid that it won't. So but
That's why people buy Bitcoin. People think of Bitcoin as central bank insurance,
and they do, and it's certainly been better in terms of performance than my gold. I don't doubt that, get that at all. And I will say that I haven't personally bought Bitcoin, but I have managers that I give money to. My basic business is I refer people to managers. I refer people to other people who are smarter than I am. And I give my money to these managers, and some of them have made me a lot of money in Bitcoin. So I can't say that Bitcoin hasn't been good to me, because it has. This has been better than my gold sitting in the vault. I've got, I mean, in the same way that I have managers that are very long cannabis and all sorts of cannabinoids, and those funds have outperformed all of the other funds that I'm in. So, I mean, I just kind of smile and laugh and, go, well, okay. I'd never really thought of being a marijuana investor before, but I trusted the managers, and the managers decided to get into it. And I mean, I focus a great deal more on the managers and its methodologies and what they're doing, and how they then how I fit them together, because I don't want to have 4 managers doing the same thing. That's not diversification. So I diversify trading strategies, and then I rifle shot a few technologies and things that I do deep dives on personally. But generally, I give my money to people who are doing the technology deep dives better than I do. But it's just it's a style that's worked, and it works for my clients.
That's fair. So let's talk about Sander piles, because it's a great article, and I will encourage anyone listening to this to go and read it. It feels like we have quite a few sand piles at the moment, and we're facing a few avalanches. Do you want to talk about this and explain what you were getting into in the article?
Well, there was a group of scientists using computers in the mid-'80s, and they were trying to study chaos theory, critical junctures. And so they would, with the computer, drop a piece of sand onto the sand pile electronically, and then they would notice that occasionally you would get an avalanche, just like you did when you go out to the beach, you're a kid, and you play in the sand piles. And those sand piles conformed to what's called a power law, that, and then they started coloring those pieces of sand red and green when the sand drops, and it drops into a stable position. And if it drops into an unstable position, it would be red. And what they would find out throughout the sand pile is you'd get these red fingers of instability, they called them, that would connect. And so you would get a sand pile that was connected with lots of fingers of instability, but as long as the next piece of sand that went on it landed on a stable part, that was fine. And if it landed on a small unstable part, you'd have a little avalanche, but it wasn't connected. But then you'd hit one of those critical junctures where the fingers of instability was connected with the whole thing, and the whole pile just collapses. And going back to Minsky, who is a famous economist from the 40s and 50s, Minsky gave us the concept of stability breeds instability. We think the more things are stable, the more we get used to things being stable, and the more we begin to invest and act in our lives. We think that today will be like yesterday and tomorrow will be like today. And so we expect, that the Fed's going to be able to handle inflation. We expect that productivity will come back. We expect that we're going to get through this COVID. It's a good thing for humanity, by the way, because that makes us relative optimists, and that gets us up in the morning and keeps us from living in caves and eating dried food. But it's that Nassim Taleb he's famous for the book The Black Swan, but he wrote a book called Antifragility.
Yep.
And it's a great book. You should read the first half of it. The second half, he just keeps repeating himself. And
Typical Nassim.
well, it is. He does that in a lot of his books, but otherwise they'd be so short. He has this really brilliant idea that he feels that he's got to expand it into something big enough to be a book as opposed to a monograph, because you're not going to pay $19.95 for a monograph, but you will pay $19.95 for a book. But the idea was brilliant. If you continue to if you continue to not allow things to have a problem, if you continue to try to maintain stability, which is what the Federal Reserve and central banks are trying to do, they are putting off recessions, they are putting off many prices, they're putting off a market downturn. They don't want anything to upset the apple cart. And so the U.S. Federal Reserve, its first mandate was to maintain price stability. Then in 1974, Congress, in its wisdom, said, well, we want you to be responsible for full employment. Like somehow or another, the Federal Reserve can magically improve full employment. But they did it nonetheless, so now the Federal Reserve picked that up and said, we're responsible for unemployment. And they have assumed a third mandate, without explicitly saying so, is they're now responsible for the stock markets. And so any, big hit in the stock market, they come in and throw more liquidity. They do something. When we had this bond crisis this last time, they said, well, we're going to buy corporate bonds. And the prices of corporate bonds, then of course, fell because the Fed was coming in. Now, the Fed only had to buy like $20 or $30 billion, some small amount. But it was just the thought that the Fed was going to buy it. Forget for the moment whether it was actually legal that they could do it. They had some lawyers tell them it was legal. That's fine. They feel like they've got to keep everything smooth, and it's keeping everything smooth makes it more fragile. It makes it more open to that Minsky moment when things get out of control. The anti-fragile thing is a way of restating Minsky's proposition, but I think it's a very elegant way to say it. It's really worth reading the first part, or there's probably some reviews out there where you get just Google antifragility Taleb and review, and you could get the basic idea.
I've read the book.
Okay. Did you read the whole book?
No, I think I read about the first 4 chapters. Me and Nassim aren't friends. He blocked me on Twitter.
Oh,
he's not a fan of Bitcoin. He used to be. But he changed his mind, and he's in turn not a fan of Bitcoiners. But I still think the book's brilliant. But everything you're saying just takes me back to Ray Dalio's video on how the economic machine works. You have to allow the economic machine to work, and if you interfere too much and delay the downturns and allow companies to fail as they should fail when they need to fail, then it takes us into this position that we're in now. And I keep thinking about this great reset, whether it's a reset which is forced by government or it's a reset by the market. And I'm assuming your preference is a reset by the market.
Well, I think the market will end up resetting and forcing the government to reset. I mean, it becomes once you start down that path, once those fingers of stability, when you hit the real instabilities and they all come cratering down, and when you get a crisis like that, and those crises tend to be periods of high unemployment, yes, the government's going to continue to send Social Security checks out and payroll, but no, we aren't going to have enough money, and we're going to be running massive deficits, and the central bank will have to be buying massive amounts. I mean, I think a $25 or $30 trillion balance sheet by the Federal Reserve by the end of this decade is not out of the question. We'll certainly be over 50 trillion. I mean, I've demonstrated that a year and a half ago before the COVID crisis. And I'm waiting to update that research. We'll put it in a future letter. I want to see what Pelosi and Schumer and friends get past Manchin and those House rebels. I'm assuming they're going to get something, but Manchin's, if you paid any attention to his article in the Wall Street Journal here about a week and a half ago, he was pretty clear that 3.5 trillion or even 2.5 trillion or 2 trillion was not on his list of things that he was willing to vote for. So, he's also indicated that he'd be willing for corporate taxes to go up a little bit, for capital gains taxes to go up a little bit. So there's a number out there of a certain number that certain government programs we're gonna get. We don't know what that number is yet, because that's still being negotiated behind closed doors.
Well, we're seeing in the UK, we're seeing attempts at tax rises. I don't know if you've seen, there's the announcement of a 1.25% rise in national insurance to cover social care. But really, I mean, all goes into one bucket. And there's talks of raising capital gains tax to bring it in line with income tax. So we're starting to see the UK government at least deal with these unpopular ideas of tax raises. But you don't.
And this is during a Tory government.
Yeah, well, that's why it's unpopular.
And that has, if you actually had a Labour government, in dear gods, what would they be looking at? So,
well, they would be spending. If it was a Labour government, they would be spending more and taxing the ultra rich and not balancing the books. But a Tory government, certainly one after a manifesto said they wouldn't be raising taxes. It's going to prove very unpopular. And I think this might be the end of this Tory government.
Be careful what you wish for.
I'm not wishing for a Labour government.
Jeremy, what's his name? But of course, I have no idea. I don't pay a lot of attention to UK politics. Only around election times.
Yeah. It's a bit of a mess, similar to most global politics right now.
Well, yeah, pretty much
you're always
everywhere.
picking. Yeah, you feel like you're always picking the worst of a bunch. The best of a bad bunch. So, yeah, I mean, look, interesting times. I think a lot of people will be thinking, listen to this. Okay, John, but how do I prepare for this? How do I get through this, retaining as many as my assets as possible? I'm sure you have a plan.
I want to diversify trading strategies, And I mean, and for me, for instance, I have a lot of money in hedge funds, and they're very boring hedge funds. They they do boring things, and they averaged over the last 9 years, because we've got them all in one bucket, that we've been able to figure it out. And every now and then we'll switch out, or somebody will close their fund down and we have to put it somewhere else. But they've averaged something like 9% a year for me. I mean, it's more like a bond than its worst year was down 0.2%, and its best year was over 20. But it's been in that 8-9% range. And if you don't qualify for hedge funds, there's other trading strategies out there in the ETF world, in the mutual fund world, that you can get. And by trading strategies, it means they're not long. They don't buy an index fund. They're trying to arbitrage something, and you can see what they're doing, and how they're doing it. I want to, if you can qualify, there are places where I do a lot of private credit, where rather than buying bonds at 2%, I can get private credit that's paying me 6, 7, 8%. And there's a lot of that out there. There's an entire world of what used to be small and regional banks would take care of. And the government, the regulators have so clamped down on what they can do, they've now gone into the private market. And there's this rather large private market out there, that, it's a little bit of a mystery, because it's not, you just can't go punch the button and say private credit and you get 50 options, or actually there's closer to hundreds of options. But you have to find a manager that knows where to go and look, and that does their homework on that. And so we put our clients into private credit. We find and that's all of that's kind of in our what we call our core bucket. This is stuff that I'm expecting to be there, and it's going to go up and down in value, but it's not going to make me rich. It's just going to get me there. I don't want to lose a lot, and that's say roughly 80-90%. And then you have your explore bucket, where you break it up into targets for technologies and other things that you think have the opportunity to do a great deal more. I'm for people with a particular personality. Real estate's a great option. It's you have to find things that fit your personality. I don't particularly want to own a lot of real estate, except maybe through another manager. But some people, and it's a fairly stable, boring asset. But I like boring.
As long as you beat inflation.
Well, and that's been easy for the last 20, 30 years. Now we have to pay attention to what Powell is going to do. I saw a funny picture the other day. I showed a Powell that looked like he was 98 years old, all wrinkled up, and it says Powell getting ready to announce his first rate hike increase. 20 years from now. There's a story, without trying to bore your listeners too much, about Chairman Burns when he was the Fed chair back in the 70s. And somebody brought him some data and said, this is going to be inflationary. And he looked at it and he says, no, it's not. It's going to be transitory. We're going to ignore that. And they'd bring him another thing. It's going to be transitory. We ignore that. And he went along for almost 8 or 9 years. It started actually in the 60s. By the time he got out in the late 70s, inflation was at 10% and rising. Because in his world, everything had been transitory, just like it is in Chairman Powell's world right now. It's all transitory. And all of those wage increases, all of the rental income and housing increased prices, all of the food prices that are being increased, those are all transitory to him. And I don't see those coming back. I think the Fed should be leaning into this. And yes, would that create a problem with the markets? Yes. I'm sorry. But I think price stability is far more important than making sure the market stays up at ever higher numbers.
What are the risks of inflation right now? We've seen various figures quoted, 3, 4, 5%. But
we're at 5 and 6% right now over the last 3-4 months.
But with certain things that aren't included within the basket, we're seeing much higher inflation numbers. I know, for example, people work in trade sectors are talking about 10 to 15% rises in prices for raw materials.
Oh yes, oh yeah, and you're seeing same thing happening for rises in prices, especially for wages at the lower sector. You're seeing what's called as owner's equivalent rent here in the U.S. You have its housing prices in the U.K. are rents going up, and it's going up by more than 2 or 3%. It's going up to 5 and 10%. That's real inflation, and the same thing with food prices. We're having the same problem you mentioned earlier. We can't get enough truck drivers. Mm-hmm. It's part of the problem is that China in their ports are having COVID issues, even though they're not calling it COVID issues, and their ports are shut down and stacked up, and all of this stuff that we're supposed to be getting into the United States and the rest of the world is stuck in the bowels of a port in China.
Are there risks that we see much higher inflation numbers from the Fed? And it feels like the Fed tries to hide real inflation, but
no, it is a real risk. It shouldn't be a risk. That's the problem. That's my frustration. It should not be a risk. And the Fed seems to think that they want to get employment down back to 3.5% in the U.S. We saw that once during the Vietnam War and once at the end of Trump's 2009 period, and those were fleeting moments. Unemployment in the 4.5 range is, to me, that's close enough for government work. We're at 5.2 now. We should be backing off. There's 10 million jobs out there. It's not like there's not enough jobs for workers. We're going to have to reskill people. People are going to have to be willing to move. I've got 8 kids, 5 adopted. So my family's more colorful than yours. I have 2 blacks, 2 Asians, a blonde brunette, a redhead, and a Choctaw Indian. But,
you're like a Texas Madonna.
Oh God, I hope I look better than that. But but she makes more money, so I shouldn't be sarcastic. One of them was saying that he's now working in Oklahoma, and he's saying, I'm getting ready to go to Florida because there's more jobs at higher pay. And he was thinking about Maine because he could double his income going to Maine, but he says, I think I'll wait till after the winter's over before I go to Maine.
That's a fair decision.
Yeah. So, people are going to have to move to where the jobs are. They're going to have to learn new skills. There's there's a lot of things that are happening. So,
But you believe the Fed should lean into this? You believe they should raise rates?
I think they should start tapering first, and then begin to raise rates. I don't like to do a two variable experiment, but I would like to see them taper $20 billion a month for the next 4 meetings, and then start telegraphing we're going to be raising rates, and just not worry what the market does. If the market says, well, we're going to drop 20%, say, well, okay, guys, market's dropped 20%. That's, we've got to control prices.
It's great to have you on, great to discuss this, and it's sometimes nice to not be focusing just on Bitcoin, to hear other opinions. A lot of Bitcoiners listening will be like, "Oh, but John, you should be buying Bitcoin." But it sounds like you've got it right with your managers and your gold holdings. But I've really enjoyed this chat, so thank you for giving up your time.
I have too. This has been fun. By the way, people just can go to Mauldin Economics or Google John Mauldin. My letter's free. Just stick your name, email address in, then you're one of my 1 million closest friends. Shows up every Saturday morning. It'll be in your inbox.
Well, I will stick that in the show notes and make sure people get to that as well. And when I'm next down in Texas having a steak, Nick.
Well, you got to come. You got to come to Puerto Rico now.
I would love to come to Puerto Rico. It seems to be a growing list of people I know there. I would love to come to Puerto Rico, hang out with you and Peter Schiff. But I'm also a big fan of Nick and Sam's down in Dallas.
See, now I used to live 2 blocks from Nick and Sam's.
Oh, wow.
I mean, I knew the staff, the bartender. They knew what to serve me, what to put out the minute I walked in.
They do the greatest steak. I had the greatest steak I've ever eaten. It was there. They can't make a whiskey. They can't make a whiskey sour, but they can. Damn, they can make a steak. So next time I'm there, I'll think of you. And when I get to Puerto Rico, me and Peter Schiff can go and hang out and talk about gold, Bitcoin, and the economy. But John, listen, thank you. I will tell everybody about this. I think people are going to love listening to this, and I hope to chat to you again sometime in the future.
My pleasure, and anytime, just call up. We'll have fun.
All right, man. You take care.
Bye-bye.